Hey everybody, I'm Tarl Yarber with Fixated Real Estate, and I'm here today with the one and only Mr. J. Scott with BiggerPockets, the master of house flipping. And we wanted to ask him some questions about what house flippers can do today in a changing market. What are some tips, some things that can make it to where you can still make money in this business, still succeed, even if you're starting out or have been doing this business for a few years like we have. So Jay, what do you got to say about flipping houses in a changing market?
Yeah, so let me start with a really important point. We never know when the next downturn or the next recession is going to come. It could be next week, next month, next year, 5 years from now. But real estate markets are cyclical. The economy is cyclical. So at some point, the market's going to change and we're going to see a downturn. So I'm not telling you that's necessarily coming, but what I do want to talk about is if you're a little bit concerned about a downturn, or if we start to see signs of a downturn, what are some of the things that we can be doing as house flippers in our business to maintain our profits while drastically reducing our risks? Because we as real estate investors, our goal should always be to minimize our risks.
Absolutely.
Okay.
So what's number one?
Yeah. So number one tip for how we can reduce our risk and maintain our profits in a changing market is we need to keep our projects short. In a strong market, there's nothing wrong with doing a 6 or 12 or 18 month project. In fact, there may be some advantages to doing a long project because the market's rising. Prices are going up over that 6 or 12 or 18 months.
Yeah.
So you project a certain profit, and 6, 12, 18 months later, you may find that you have a higher profit because the market's gone up.
I know I've gotten lucky on that a few projects here in Seattle, Washington, for sure.
Anybody that's invested over the last 10 years has probably seen that market going up and helping them throughout the project. But in a changing market, in a downturn, in a market where prices are going down or potentially going down, a 6 or 9 or 12 or 18 month project can be risky because we don't know where the market's going to be in a year or a year and a half. So typically speaking, I am staying away from those large projects. I'm staying away from the really complex rehabs. I'm staying away from the ground up new construction, and I'm trying to stick with shorter projects, 2, 3, 4 month projects. And so that way I'm in and out. If the market starts to change, I'm out before we see any significant downturn.
Perfect. So that's one. What's another one?
Second thing I'll say is stick with what we call the median house price in your area. So in any given area, there's kind of an average or median price for which most homes sell for. Typically speaking, when the market starts to slow, the market slows at the much higher price points and the much lower price points before it starts to turn at the median price point. So let's say you're in a market where the average house price is about $300,000. You might want to stay away from those houses that are going to resell for $8, $9, $1 million. You might want to stay away from the houses that would sell for $50,000 or $100,000. If you're in a market where the average price point is $300,000, try and find houses that will resell for about $300,000.
I guess that makes sense because that's more the middle income families, the second time home buyers sometimes, first time home buyers. Because when a lot of people get started investing, they go like, well, 300, 400,000 is a lot of money, so let's go for the really cheap houses that are 50, 60 grand, and they think that's how they're going to make their money, right? So that's a good point because that's also a market that'll shift faster versus the medium income, which is where most people are buying their houses.
Exactly. And when the market starts to shift, those low income houses, those houses that are much lower than the median value, those can be the houses that are harder to get loans for. So buyers are going to be more, they're going to find it more difficult to get loans to buy your houses in those.
Right. So that's two. What's another one?
Number 3, avoid thin deals. So a lot of us in a really hot market, sometimes we accommodate that market by saying, okay, we're going to do a thinner deal instead of accepting
volume, just keep going.
Yeah, just we'll do more volume and we'll do thinner deals. The problem is that's fine in a market that's going up. Like I said, if you're in a market that's going up, that thin deal by the time you go to resell it might actually be a great deal because prices have risen in the time period that you've been working on the project. But in a market that's potentially changing, doing a thin deal is very dangerous. If you do a deal that only has a few percent ROI and the market drops a few percent, you could quickly find yourself doing a break even or even a losing money project.
Which is absolutely horrible in a lot of ways.
Yeah. So especially in a market where you're concerned about things changing, where you're concerned about a downturn potentially happening before the project's finished, stay away from those thin deals.
Good idea. And that's something that a couple of years ago, my wife and I decided to stop. We did a lot of volume and we said, let's just do big juicy deals, which we all want those big juicy deals. They're not easier to find though. They're a little bit harder to find. But it gives you a little bit more comfort, a little bit more simplicity for changing markets. We have a lot more risk management because of that as well. It makes us sleep a little bit easier because of that. And the good news about it, if it's already a big juicy deal, when it closes, it's a big juicy deal. And if the market kept going up, it's even juicier. The market went down, we still make money, right? So, but less stress. That's a key thing, less stress. So, all right, we got, what is that, 3?
That's 3.
What's another one?
Okay, number 4. Don't chase your market. This is actually the biggest mistake I see house flippers make. That the market starts to change, things start to soften up, values may start to come down a little bit, but flippers tend to be a lot more conservative or a lot more aggressive. They don't want to drop their prices. They think, I'm just waiting for that perfect buyer to come around. So prices may drop 5% and the house flipper says, okay, I'm going to drop the value of my house or the price of my house by 1 or 2%. And before you know it, prices have now dropped 8% and house flippers have dropped their prices another couple percent. But they never
accept the market.
They never accept the market.
Yeah.
They don't get aggressive enough to sell that house. They keep thinking things are going to change or the right buyer is going to come along. And this is the biggest mistake that I see investors make. So if you see the market start to change, if you see prices start to level out or start to drop, do what you need to do to get that property sold. Even if you need to drop the price, even if you need to do something to accommodate buyers like offering more concessions, do that, because it's better to sell now at break even or maybe even just a small gain or a small loss than to wait 3 months or 6 months and find yourself taking a big loss on that property.
Absolutely. And I know, I love that you said that, because like I tell my team this, there's been projects that we've had that we do that, okay, well, maybe if we wait till this time we could sell, maybe we hold it a little bit longer, maybe we just like drop only like a little bit of money. Then in our business, because we're doing this as a business, we're in the business just to keep doing properties, not make all our money on one deal, right? And so we're like, if we have a deal that's like not doing too good or the market's shifting or whatever it might be, get rid of it and move on so we can keep moving forward to the next thing that we're doing. There is another thought though. There's a lot of people that think, that I've also heard, where the good thing about real estate is if the market changes, just wait, right? And so it's another concept some people are doing is that instead they're just keeping these properties as rentals, and they're going like, okay, I can't sell it for what I want. I don't need to sell it technically right now. I'd rather just keep it, and they might hold it onto as a rental. And even though the market shifts, the longer you wait, sooner or later it's going to change. Even if you might have to wait 10, 15 years, but something's going to happen there. So that's another thought too.
That's a really good point. And that brings me to my next tip.
Okay.
Always have, this is number 5.
Okay.
Always have multiple exit strategies. So if you're going to do a flip property, if you're going to analyze a deal for a flip, also analyze it to make sure it works for some other exit strategy. Make sure that it would either make a good rental property, maybe it would make a good lease option property.
Yes.
There are always multiple exit strategies that you need to employ at this point in the market, because if your plan A doesn't work, you want to have a plan B, a plan C, and maybe even a plan D.
Love it. That is my favorite tip for you guys. The best deals have lots of exit strategies. It's a great flip and it's a great burr. Which one do you do, right? Or it's a great flip, great burr, and you can also peel off a lot and do an extra development. Oh, and you get all these different things. Those are the coolest deals that you can do in your deal, in your business. And it's something I wish I learned years and years ago, because I was just flip. And over the last 2 years, we've been more multiple exit strategies, and it's totally changed our business. So if you guys like videos like these, let us know. Comment, like, and subscribe. Say hi to Jay as much as possible. Where can they talk to you?
I'm on Instagram, jscott_123flip, or follow me on my website, jscott.com.
And I'm Tarl Yarber. You can follow me at Tarl Yarber in the Instagram thingy. Facebook, Fixated RE is our company. We do a lot of stuff on there. And of course, all the BiggerPockets. Definitely subscribe to YouTube with BiggerPockets. And we'll see you guys in the next video.